Okay, I'm back. Yeah, yeah. So,
Okay, good afternoon, to everyone. Welcome, to the Asia Pacific University of Technology and Innovation. Today we are having our Enterprise Wednesday talks as usual, and we have a very special guest with us today. Yeah, so he's all the way in Singapore, and we are actually really appreciates that he's actually here. So I'm actually your moderator and host for today. I'm Professor Dr. Angelina Yee, and with me today I have Divesh Praram, which is my student, and he's also with the E Club Enterprise Club of APU. All right, so today we will be discussing on, well, what do venture capitalists look for in a startups? So this will be useful, for startups, who are ready to scale up. You might be seeking for venture capitalist fund, and it's just one of the other options which are actually available. So today, we have Mr. Boon Yong, who will share some insights with us on what venture capitalists usually looks for in a startups. So let us do a quick introductions, of Mr. Leo, who are with us today. Yeah. So Mr. Leo, thank you very much for accepting to be our guest, for
thank you
today.
for having me. Yeah, that's right.
Yeah. So,
Yeah.
and I would like to say that you have a very, impactful and a very interesting bio as well, background. All right. So let me just quickly share with you, on the Leo. Leo has actually been practicing engineering, in the aerospace sector, and he has been involved in designing helicopters, for 5 years, after graduating from an aeronautical engineering degree. Surprisingly, after that, he went ahead, and he's actually completed, his MBA at the Water School of University of Pennsylvania. So from here, he moved, from engineering to MBAs, and he's also has taught a short experience as well, in the teaching. So he has started his finance career in New York, structuring, risk managing, and trading complex financial derivatives. So from here, with his vast experience, in the finance background, he has actually co-founded a social enterprise in Cambodia that focus on agriculture, real estate development, and hospitality services. He has vast experience, from being the from the engineering to finance environment background, and he also has a huge experience now, as a in venture capitalist, where he actually looks into fundraising, and also, in terms of working with the ASEAN countries. So Leo, I think you have a very impactful portfolio and also vast experience. Let's introduce, more details in terms of what you do, in this arena of the enterprise and entrepreneurship related. Welcome, Leo.
Okay, thank you very much. I think having started my I guess my second career in finance,
Mhm.
I think that subsequently I had an opportunity to look into the small and medium-sized enterprises, and that's where it's some of them are obviously in the startup realm. So I have actually worked in advising companies in actually in the real estate technology side, as well as one on the potential acquisition for a data center services company, and I've also advised on a robotics company. And so, what first I want to maybe let everyone out there who's actually um, very entrepreneurial and having their own startups and ideas. I think it's important to know that this is something about statistics, but don't be discouraged by that. Is that I think usually is that
Yes.
8 out of 10 uh, startups right actually don't make it through the funding round. I think this
Mhm.
is pretty much the statistics, right? And I guess that is the nature of the business. And then for venture capitalists, right, when they invest as well, they are actually careful, but of course they have to take risk as well. And that's why I think that you will see that the success rate, if you can achieve a hit rate of 50%, you're considered outstanding. Yeah. But usually what people are looking for is that you have one or two good hits, right? And that gives you a huge multiple of return, and that's what venture capitalists look for. Okay, I think for starters, I think what VCs look for, and I've sat on the VC side, and looking at companies and doing all the the scrutiny, but I've also helped entrepreneurs to sit on the company side so that to advise them what to look for and to prepare them when the VCs come in, so that they can get a fair deal. Okay, I'm not talking about whether you get a high valuation or low valuation, but I think the important thing is a fair valuation, because what is high valuation for the founder is means that it's actually not a good deal for the investor. Was a good deal for the investor may not be a good deal for the founder. So I think very important is that you need to strike a fair deal, a fair valuation, but not a high or a low valuation.
Mm,
So now I think when I look at companies standing from the VC side, I would say that they are actually obviously you're looking for a big C, which is capital, and I think that
mm,
there are three C's that you need to look for. And the very first one obviously is capabilities, right? When you do a startup, it's very important to you know not be too immersed in what you do, but sometimes you will take a back seat and say, no, what take a step back and look from the outside and say, well, what are your capabilities, right? And what are the strengths in the company, and what makes it so unique, right? And it's like, not like you're like one of the many out there. Then when it comes to approaching an investor, then investor will have to have a lot of choices, right? So I think capability is very important, and the capability is got to be whether this capability, or you can put it the strength, right, is something that is unique, that's prevalent, or something that's up and coming, uh, and something that's of perceived value. Well, I say perceived value because people see value differently. Some people see value as in that it can be realized very quickly. Some people see value as in you need to bring in other parties to try to get it to work, and some people see value is bringing the access to the markets. So that's where sometimes the investors, this the selection of the investor is equally important. So if it's a strategic investor, then the investor can actually bring in the clients, right? Or the investor can connect you to the right partner that
mm,
could actually enhance your product or your skills. So I think this is definitely a very big C that one need to take into consideration. Okay, I think the next thing one will look for is collaboration. Collaboration in a broad sense of the word is how open are you towards working with others. That's number one. And that whether the startup itself, if there's a team, how does the team work together, how does the team gel. So
mm,
the collaboration comes in a couple of dimensions. One, internally, is how the team gel among themselves. Is there a chemistry in
mhm,
there, right? Can they get along? Is someone that's dominant is just saying yes and everyone follows, or is it very collegial? So I think these are all the dynamics that one will look in collaboration internally within the team. And then the other collaboration is external, in the sense that how do you work with your vendors, people who are your channel partners, or how do you work with your clients? Are you client focused, and do you have a good relationship with your clients? So I think this is where external comes in, right? And then
mm,
there's another dimension is with institutions. So sometimes is there any potential collaboration with universities, institutions of higher learning, or with government entities, because sometimes the work you do may require regulations, or you may even have the government as your launch client. So I think these are the dimensions that one will look at, right? Is internal, the external, and then the peripheral. We need to say that the secondary, all the supporting actors and stakeholders within the investment ecosystem. Okay, and the third one, of course, is very important. Is some people call it credibility, and some people call it character, but they're the same, right? Credibility. They got to look at the
mm,
credibility of the founders, whether
mm,
they are able to how far they have gone, and how much they've persevered to come to that particular stage they were, or they are at that particular stage when the investor was there knocking at their door, right? So if you are, um, I guess, credible in the sense that you have taken a lot of, you went through a lot of challenges and you overcome them and you've achieved a couple of good success points, then I think this is something that people see. Yeah, okay, there's some perseverance, right, to be able to operate in the long run. Because
mm,
when you are obviously at the startup stage, like you say, startup, right, you're still probably like 1 or 2 year old or 3 year old. So if at that point in time you're already showing a drag in terms
mhm,
of the character breaking up, then it's very difficult to then, once when you take the funding in, when the demands are much more, to be able to survive the scrutiny and also the pace going
mm,
forward when you have the investor funds coming in, right? So I think the credibility and of course credibility character we talk about is the basic things that people look at, right? Are you someone who is trustworthy? Are you someone who is able to do what you say, right? Are you someone who is able to walk the ethical route? uh, I think that's very important because we've seen a lot of startup cases, especially not even in Singapore or not in Asia, but also in the West,
mhm.
right? I'm sure you heard of the big
Yes,
case of Theranos, right? Um,
yes.
so who is now being accused of falsifying reports, and in fact there was also a recent startup in Singapore, or not a startup actually, the one that received funding and then end up, the CEO was removed, right? Because there was some discrepancy in the accounts. So you see, all these things comes into play, right? So in order to be, and I see that with these three C's that I would just summarize
Mhm,
it so that it's easy for you to just encapsulate the ideas. You can see that um, if the way that you're operating right now, and you can use those three C's to see how you fit those boxes and give yourself a particular gauge of where you stand, then you can probably have an assessment, self-assessment of your team and yourself, whether you're ready
mm,
for funding. And usually for VCs, usually we call this Series A, right? I think
mm,
it's just Series A is just like just a special unique term to say that you got your first start round of funding, right? And like
mm,
those private equity firms, when they actually invest in, even like the likes of Grab, Grab
mm,
actually went down to even Series D funding. That means they
mm,
just keep raising funds and raising funds and raising funds, right?
mm.
So now I would pause at this while before I go into more details of each of the C's and the process. So, is there any questions so far?
Just want to ask you one question, Leo. When do the startup really look for funding from venture capitalists?
Okay, so here are a couple of points. Yeah, the way that one to think about it is, when you start up, everyone obviously will bootstrap, right? They pay themselves a little money, or they just borrow
Mm,
some friends and family money, or they use their own pocket
mm,
money. They start something. They try to work something out, and once when they work something out, then what they do is, when you have some clients and when you have some revenue stream coming in, it
mm,
means that your product or your service has attracted um, client demand. So that means there is
mm,
supposedly a market need, right? So this is from the revenue side, right? So
mm,
I think this is where um, one can say that when the revenue is coming in and there's traction of revenue for at least, I would say, 6 to 12 months,
mhm,
and don't hold me for, as a kind of fixed rule, but generally what I see is that usually when they have 12 months of revenue stream, it means that they're already able to service one, two, or a couple of number of clients on a continued basis
mhm,
within a year. So and that would be one consideration that one can look at. Okay. The other consideration is now
mhm,
from a go-to-market strategy in terms of
mm,
looking at the partners, right? Let's say, for example,
mm,
you have, so that's from the revenue side when you produce a service or a
mhm,
product. Now, when you look from the solution side, if you're able
mhm,
to attract a partner or two that wants to work with you to apply whatever you have, a service or a product, uh, and that uh, and that kind of collaboration has been inked, and it
Mm.
is now ongoing with a certain commitment from the partner in terms of, um, I guess, confirm contracts, right?
I see.
That is also a positive. It's a positive sign because if one particular partner is signed up, and generally the case is that particular partner, if you're serving a very big need and to whatever that particular partner user, right, and that partner user will probably want to take a strategic stake in you. I would think,
Mhm.
okay, it makes logical sense. But
Mm.
if this is something that you think that the market is, um, I guess, much bigger than just being tied to one exclusive client, then okay,
Mhm.
then this is where now you start looking at other potential partners, or you raise funds to go and now pitch to other partners, right? So I think this is now from the product side of the business, right? So I think this is where two angles that one should look at in terms of consideration for the funding, right? And of course, it's not. I guess the first case where you usually have to run on your own is if you're a product-based company, then you have to do or even a service platform like a software. Then you have to really do the POC, I say the proof of concept
Mm.
yourself, right?
Yes.
Yeah. Then when it comes to the proof of valuation, means in terms of the mass and production, and everything, okay. So then from the technology and software angle, this is where now you can look for, possible source of financing. Is that if the POC is successful and you got one launch client, then that's where the proof of value comes in, right? You can now
Mm.
approach some companies to say, well, look, I need some funds right now because the product is there and there's potential, and that's where you can start to pitch, and then that's the pitch round. This is when I'm looking for investors. I think this is the next subsequent points I'm going to raise later on. I think that's where you got to decide what kind of investors you look at and whether they're strategic or not. So I think these are all the things that needs to be on your checklist. Okay, so I think as far as your question, then I say that, yeah, once when there's some certainty of revenue, then I think you can look
Mm.
for financing. And usually some of the VCs as well is when they look at coming in at the Series A level, because they can't look at profitability because this is like startup, and then when people look at it, right, people cannot,
Mm.
you don't have the 3 years of audited
Yes.
accounts, da da da, and all that. So what they do is that even 1 year, they just look at what your revenue is, uh, uh, what you have achieved, and sometimes
Mm.
they'll just take a 3 to 4 times multiple of the revenue and say, well, this is the kind of valuation I would value you at, and then I will put X amount of money, and that X amount of money divide by versus this valuation is the kind of percentage I want to take the stake in your company.
I see. Oh, okay. So they do a roll forward as well.
Yeah. Okay.
Estimation. Yeah.
So that's when, obviously when they see that there's potential lah, right?
Mm.
One example, let me see. Okay, now one example that I give one example that works and one example that doesn't work. Okay, typical went through an M&A of a company that is actually a data center equipment and services provider. They have been running business for so long. The founder wants to retire, and then we look at this particular company. These companies are always just run of the mill, steady state. Some base clients they have. So when you look at that, right, we just say, okay, how much earnings, net earnings, or maybe even something
Mm.
look at
Yes.
EBITDA, earnings before
Yep.
income tax and depreciation allowance. So then you would just take a market benchmark and say, okay, I would then take, maybe I'll look at it and see if the company is good. Yeah, I might say the range is between 3 to 5 times multiple of your earnings, not revenue.
Yes.
Okay,
I see. Mm.
yeah, and the simple logic is very clear. Is that why they use the earnings approach? Because there's already been market precedent, right? So,
Mm.
and if this is a steady state business and it's generating cash flows, then you use it. But if you're a startup, like say, you got no steady state cash flows.
Mm.
Here's another example. Okay, had a robotics company. Robotics company had generated in the first 12 months $1 million of revenue. Okay, sales. So they got a contract to generate sales. And then when they approach the VC, or I help them approach the VC, I have to do up the pitch. So when I did up the pitch, I've got to say, now look, with X amount of dollars, how much we're going to raise, what we can do with this particular product, which clients we can reach, we can kind of access,
Mm.
and we have all the potential pipelines lined up. And obviously for robotics companies, if able to build as well, not just the software, right? Able to build the robots as well. that has good multiple, and that was actually valued at a multiple of 10.
I see.
So yeah, so then the company was worth 10 million, and then the VCs, they placed in 2, and then that makes it 2 divided by 12 as a percentage of the shares in the company.
Mm.
Okay, right? So 2 divided by 12, yeah. So we talk they're 16 and the third percent in the company, right? Okay, so that's the first stage. Now, obviously, taking investors' money has responsibilities. It's part of stewardship. That's where the last C is very important, right? When you take the
Yes.
money, then what you do? You take the money and then you go and spend it all, pay yourself a ton of money. It's not going to happen. Okay, there will be what they call reserve matters. What are reserve matters? Say, for example, you want to buy a property as well. You always have conditions, right? Make sure that they have warranty for a certain period, and any damage this person must fix if you're buying on a resale market, right? So likewise, if a VC will invest in the company, they will put some reserve matters like saying, okay, fine. If a company is valued at 10, let's say I put in 1 million. I will not allow you to, you can pay yourself some small money, but I want to know how much you pay, and you cannot pay
Mm.
yourself at market because you guys still own the shares. And generally, when a VC comes in, they know that they will not want to take the majority. But you take the majority, you have from a company perspective, the voting rights control. So that's where Reserve matters are very important in order to
Mm.
at least steer or guide the executive management team to act in a way that is constructive for the company and the investors. So certain example of reserve matters is like obviously you say, okay, you can't pay yourself market rate. So what's the amount you're going to pay? They want to be able to have a say in that. At the same time, is that the funds they put in cannot be used to pay any debt whatsoever. Must be used for growth. So specifically, you must then state that for this amount of money to put in, how you going to allocate this money.
Mm.
So how you going to use this money, right? At the same time, there'll be certain covenants in there to say that if you want to borrow some money from the banks, because once we have investors coming in, banks are very happy to support because then straight away your share capital get boosted, and so they can lend you based on a multiple of your share capital, right? So then how much of funds can you borrow, and when you borrow as well, what are you going to use it for? So
Mm.
the VCs are definitely very hands-on in that, right? So it's not someone, I've never heard of someone who's a passive VC, right? Those are called angel, and they're called angel for some reason, right? Because they give you the money and they close their eyes, right? But of course, some angels can become your worst nightmare as well because they are not angels, but actually, the other side in disguise, right? The Darth Vader, okay,
Yeah.
and they can give you help, right? And they will not say reserve matters. They'll just put a broad thing saying that everything you do, check with me. I think if that's the case, I wouldn't want to take the money. Okay, that's something that I tell you first is that you have some money. There must be a balance, right? Because they're taking some shares in you, and you've
Mm.
toiled, blood, sweat, and tears for a period of time. You cannot end up taking money and then having your hands tied. It
Mm.
doesn't make sense because you know your business, you know your
Mm.
product, and you want to set the direction. And if
Yep.
someone put money to work with you, I think that's great. But if someone put the money and tie you down, that's something that you don't want to get into, right?
True.
And oftentimes people don't see it, or people just say, well, just take the money and think about it later on. Don't do that, right? Because I think that take the money first and think later is like kicking the can down the road because these problems will be there and it will come back to haunt you one day, right? So that's one definite no go. I would, in my own opinion, do that, right? Okay, and I also come across. I think like also I need to also I guess caution everyone that whether you're an investor or whether you are actually a startup. Like
Mm.
I told you before, right? Not all startups can succeed, and like I
Yes.
say, I'm humble enough to admit that I have my own fair share of failures, and I tell you and sometimes the nightmares are really tremendous because it's like people from the character perspective turn out to be okay, but once when the money comes in, or they suddenly mutate, right? Not into a butterfly, but into something that is the opposite of a butterfly, right? And I've got people who end up, you lending them money and investing in them, and once when the money comes in, they kick you out, right? By method of excuse, right? So I think this is where now the lessons from an investor standpoint is you have to put the reserve matter that will um, coax the founder to behave in a way that they should behave. That's important, right?
Interesting.
And I think that for entrepreneurs, right, you should not take it personally, and you should not take it as it's very insulting or degrading, because why is the money comes in, people need to protect the funds that come in, and very important is what they see, the potential. They need you to also um, continue to build on the good work that you've done, right? And then they, of course, they have to also protect themselves in the sense that what if it turns out that the entrepreneur is trying to mislead people, right? So
Mm-hmm.
we have our fair share of cases. So that's why it's very difficult to uh, to tell in just a couple of meetings, and even with the due diligence. So that's why the reserve
Mm.
matters are very important. And for um, entrepreneurs, they should not take this from a negative sense, right? It's just that investors need to do what they need to do.
Mr. Leo,
Yeah,
I have a question. Earlier you said, credibility is one thing that venture capitalists look into, startups, like
yeah,
for their founders and such. You know, are there any other, potential risks, venture capitalists look for in a business? Like anything out of the, ordinary, some things that people don't really, know about that you could share
yeah.
with us?
So okay, yeah. So this is where now we can go back to the three C's, right? The first thing
Mm.
on the capabilities, right? Capabilities, like we say. So I'm trying not to use the word technology here, because it could be something that is non-technology related as well, right? Or sometimes,
Yeah.
like you say, in agriculture or whatsoever. So when they look at capabilities, right, they say, oh, you're capable and you're able to do this and that. That's great. And in the capabilities box, you would then look at what are the performance and deliverable risk. Let's say, for example, I've come across, I met companies, and that was very quick, because I was sitting down in a session of four guys inside there with one particular backer as well, kind of like a institutional investor. And I just went down there within an hour, and I was just like, I took nothing. I nothing, none of them impressed me. Okay, like for example, I start with the first one is that vertical farming. I say, oh, that's great, they're doing vertical farming, and they're saying farming. I say, oh, so now what sort of yield are you having for this particular vegetable? Okay, so I asked, they say, oh, well, actually, we were not very clear. Okay, you're not very clear about yield. How long have you been farming for? Oh, we've been farming for 18 months. You mean this? And how long is the cycle? The cycle for vegetables, I know, is 3 months, right? So that means you've done 6 cycles, and you tell me you don't know what's the yield per kg that's coming out. And I said, well, where are you farming? Oh, you're farming in this particular place and everything. And so when you need funds, you want to increase your position, your areas or whatsoever. They say, no, I think we're going to convince somebody to lease, to rent the space, and we use their space to plant. And we and the guys assumes the risk, and then we just plant for them.
Mm.
I'm like, yeah, if you're so sure of technology, why don't you take the risk and then take the returns, and rather gives the guy who's renting out the place to take the returns? It doesn't make sense, right?
Yeah.
So, and then they've just been working out for 18 months, and I think the revenue they achieved was not even high. I don't see any revenue, maybe 50,000 or something, and they're asking for a valuation of $5 million. I'm like, okay, fine, thank you very much. Okay, next. Okay, right? It's not gonna happen, right?
Uh,
And
Have to be very
instead of
realistic, huh?
yeah, so instead of
yeah.
talking to me more about farming, they tell me about all this IoT, this equipment can measure this. But are you selling equipment, or are you doing farming? Right? And so none of them got any farming experience, and they're all just tech guys doing IoT. So how are you going to talk about this? So it's not realistic, right?
Mm.
And so it doesn't make sense. then comes to the next guy sitting next to it saying, okay, fine, he's going to have this thing that's AI, he's going to create all these little AI applications, and he's going to put it on the platform, and people can subscribe to the AI libraries and pay for the libraries and use it, all it works and everything. I said, that's fine, great. When you started 6 months ago, right? And they say, oh well, we're going to raise funds and we're going to do listing in the next 1 year. I'm like, wow. At least where on SGX? I'm saying, you kidding me, right? It's not going to happen. Because why? On Catalyst, right, you have 12 months of track record. You can list on Catalyst, right? But I was a bit confused. And what's more is that the CEO previously was from another. I checked, it was CEO of another company. I said, if you CEO of this company, then now how can you running this? Oh, say I'm going to resign from there and run here. I said, then what happened to the other startup? Oh, someone is going to do it. Oh, so then he's what you call your typical serial entrepreneur, right? He hops from one startup to another thing, and then the other startup doesn't work. You pass it to someone else. So this is where the like you say, you look from a technology perspective and the risk perspective or the capability is there, but this one comes in two together. Is that even the character risk is there, right? So it came all together, right? So then the other one you look at is that there you have two. The third one was trying to bring in sound-based technology, like what you do, Alexia, or
Oh.
yeah. So that
Interesting.
concept they're trying to do voice activation, da da da. That was like I think 4 years ago, right? So two guys coming in and saying all the works is great and everything, and that's where you look at the collaboration risk. Is that one guy is marketing and one guy is a PhD who can do all this work, but the PhD guy is doing it part time. He's got his university work and he just do it on his free time. Then I say that, well, then if the money comes in, who's going to work? Or marketing guy going to work? Then where's your product? You need people to hire the product, right? Then people say, oh, then I'll think about resigning. I say, you think about it, lah, but the money comes in. I think you better think first before the money comes in. So this is where now you see the collaboration risk inside there, right? So so that's one thing that, and what's more is that when I have the fund manager sitting inside there investing in all of them, this is where now another potential conflict of interest, right? Because the fund manager probably had put some money inside there, boost the valuation, and probably needed someone else to come in and then achieve a new valuation so that then he can actually increase his value, right? And then continue his fundraising. So it's not going to happen. So this is where now a potential conflict of interest comes in, and conflict of interest is very important factor that one need to avoid, right? Conflict of interest then creates your risk that you talk about in the capability box, the collaboration box, because collaboration box, if let's say for example, the guy who's still working in university and then coming out this do this part time like garage basis, and you have the guy in marketing, and this guy university choose not to do it, then the marketing guy is stuck, right? So obviously there's a conflict of interest between the company, the startup, and the university's a guy who's actually teaching in university or doing research in university, right? Correct. And if you're doing research in university, then what if there's a risk, a strong conflict of interest? Because if you're researching in that
Yes.
particular field and you want to take it out to the startup, university can say, excuse me, actually that belongs to the university. I'm sorry.
Yeah, the intellectual property part. Yeah.
Yes. So I
Yep.
think this is where now you have to figure, especially now you're an APU, a lot of things that the students will work with the prof, and the prof is happy to be constantly in the background supervising it. Then there's less of a conflict of interest, right? And these things got to be spelled out upfront, because otherwise these kind of ambiguities will create a lot of entanglement down the road. Okay.
True. True.
Okay, so
Yep.
I think so. Like I say, definitely when for venture capitalists, right? Like you say, the risk, the product risk, the technology risk, the deliverable risk is under the capability box, right? The conflict of interest and the, like I say, the ability to interact as a team, right? That kind of risk also you look at in the collaboration box, and the character risk, right? I mean, I guess I don't need to go into that. Yeah. Okay. So
Definitely.
one would know that. Yeah. Okay.
Yep.
Okay.
Yep.
Okay. Good.
Yeah, we just want to remind our audience as well. Please actually key in your questions into the chat box. Okay. Divish, you have the next question as well.
Yes, I do have one more question, sir, for you. You mentioned a lot of other, several startups earlier about you saying about, people saying this and that.
Mm.
What other types of startups, venture capitalists are like looking to invest as of, this year, or like they see the potential risk in isn't as high as like other startups, you know what I mean? Like could you give us some examples?
Okay, I would say that there's no such thing as the flavor for the month because there's so many different kind of venture capitalists, right? Some would look at technology, some look at pharmaceuticals, some look at manufacturing processes, and some even look at agriculture and the likes, right? So I
Mm,
cannot say that there's particular flavor for the month, because then if that's the case, then
mm,
everybody just uh, you know sway where the wind blows, right?
mm,
So it's not going to
Yeah.
happen. But having said that, is I can only say from what I've done before is that I work with robotics company, data centers, equipment provider, real estate technology platform, a software platform, consumers.
mm,
What else have I done? Even like right now, like I say, I'm doing is a security firm. That one was also actually um, interesting because it's a bread and butter business, but it's just that run run like like the typical SME, right? You just do the business, and after that, the kitchen is in a mess, right? So that's why for me is I have to really dive into the kitchen, roll up my sleeves, and get the whole process up and running, and also the accountability and the transparency, and also to assign the right profitability to each and every contract they have, and
mhm,
make the managers who in charge of it accountable.
mhm,
And then I created a platform uh, that is a management accounting platform that enabled me to take the payroll, which are the direct expenses, the accounts payable, the revenue, to bring it on to a particular platform, to be able to um, assess the P&L for each and every site,
mm,
right? And then the platform I have is called a shuttle. And it's still in use, so that each manager can go in and see their own that is being filtered, and at the same time, is the manager can see everything, and then you can press a button, and then it generates a report for you, and you can have all the various analytics you want, and you can have all the parameters, and you straight away for management they can access it, right? And they can access it anywhere, anytime, uh, as long as it's uploaded. And it's unique in a sense because in typical companies as well, very important, right? Once when you scale up, you got to understand about the systems. In the systems, right, is how do you get all this information to be able to put it into a particular platform that everyone can see and the investors can also see. So
mm,
I think this is where now it's very timely since you asked a question. It comes back now to process. Okay, I think the thing that I want to talk about is then process. Okay,
mm,
okay, but before that, actually, I want to talk about is actually the business model. Under the capabilities and all these three together for a startup, right? You need to think
mm,
of the very important is the business model in the sense that you got to understand the entire value chain and where you as a startup stand in the value chain. Okay, if
mm,
you are in the value chain, uh, then you got to understand that are you actually a service provider, or are you a middle, uh, I guess, middle chain value addition, right? Or are you the last mile to the client? Okay. So I think this is where you got to think about. Then once we understand it, right? I'll give you an example. For example, Intel. Intel just provides the
mm,
chip into the laptop, and they say Intel inside. Intel never
mm,
go into building up the laptop. So Intel's client is the likes of Dell and HP, right? Or Asus,
mm,
the people build a laptop. So they know their
mm,
client. So they don't go to the
mm,
end client, which is the last mile, right?
mm,
Whereas Dell is your last mile client because they sell online. Previously, they started, they reached the last mile client, right? So for them, distribution is very important. That's why Dell, I'm sure have a kind of a distribution in Penang, I think, right? And then they have all the
mm,
warehouse. all the computers there and laptops. When you order from Singapore, even it comes from Penang and then send it to your house directly, right? So that's Dell's strategy. So Dell is actually closer to the last mile. We call it the last mile
Mm.
because
Mm.
it's the client, right? Correct.
Yep.
So I think this is where now in your business model you got to think carefully that then okay, who's your client? Then once when is your client, right? Do you going to charge him product by product, or if you're a service provider, do you want to sell the entire platform, or you want to sell it as in a software perspective, you want to sell it as subscription as a service, correct?
Mm.
So these are the things that one has to really think about. Uh, and for software companies, right, I tend to try to think in terms of the subscription basis model,
Mm.
principally because it's what they call the MRR, the monthly recurring revenue that people look at.
Yep.
Okay, and once we get a subscription, right, every month, it's very easy in a way of just a rule of thumb, right? The VC guy looks and say, okay, fine, you one client is $100 a month, right? I get 10 clients, then I get $1,000 a month, right? So then that works out to be $12,000 a year. So that's how they would say, oh, and this subscription is 1 year lock-in or 2 year lock-in. Then they can see all the revenue streams, and from there they can see the cash flows, and then they can do all their valuations, right? So this is where now I think the business model one we have to think about. Okay, and inside the business model, I say again, where you are in the value chain. That's number one.
Mm.
Number
Mm.
two is what's your value proposition? What are you offering people, right? So when
Mm.
you're offering people, then you got to price it. And do you want to price it at a cost plus basis? Meaning you say, if this is a cost, you put a certain markup in your money, or do you want to price it if the market allows you to price it in terms of the perceived value basis,
Mm.
right? I mean, I'll give an example, right? A typical 737 plane fresh on board coming up is about, I think, 200 million, about maybe
Mm.
it's 150 to 200 million. And then Boeing will say, okay, you want to buy the plane? Great, buy it. Now, do the next thing Boeing is going to do? Do you want to buy this whole life cycle maintenance stuff? Then we can offer that for you, and that's another X dollars, right? Correct. So you
Mm.
see that model has actually been, and then you need your pilots to be trained, right? In Seattle, okay, that's another X package, right? So
Mm.
they break the package up. So likewise for computers now, I'm sure you notice, right? You go to shop, you buy the laptop, the guy will always say, "Hey, actually, Dell gives you 3 year warranty, but do you want some on-site warranty in my shop? You just bring to my shop and I'll do it for you, right?" And so you can pay the
Mm.
extra money for that. So
Yep.
that is really the life cycle stuff. So you got to think, where is your value proposition? Do you want to continue that service, or you don't want to? Then you just sell the product and you work, and you focus on that, right?
Interesting.
So the value proposition is very important. So you need to understand firstly where you are in the business, your business model. Second is what's the value proposition that you are actually providing. Okay. A very, I mean, I'm sure you heard about long history before. Even big companies, they kind of miss this kind of mistake, right? It's like, I'm sure you know the likes of Kodak. So they make cameras and then they make films, and then they want to focus on films. They forgot that cameras being digitized, and then the film dies, Kodak dies, right? So that's a very good lesson to learn, right? So one needs to understand. Okay. Yeah. So now back to process. Now we talk about process. Okay. I think this is where now the last part I'm talking about the process. So the process is that when you run a business, you're so busy doing all the works and everything, but it's very important to make sure that you keep a proper record of the revenue, invoices, and a proper record of the expenses. Uh, yeah. So that at least, I mean, I'm not asking uh, you know I'm not asking every startup to be an expert in accounting, but it's just keeping a proper
Mm.
record. That's it, right? Or this sort of stuff you can ask, you can pay someone a small service fee, and you just get in all the invoices and vouchers, and then they will just compile it and put into a kind of
Yep.
a legible accounting format for you. Okay, so don't underestimate that, because when it comes to investing and an investor looking at, okay, the first thing they're going to look, okay, once they go into the capability box, they see the technology, that's good and all that, collaboration, yes, characters are good. Now the next thing, right, they're gonna see is, hey, where's your documentation? I need to look at your books, right? You
True.
said that you made $1 million. Show me that you made
Mm.
$1 million. Where are the invoices? Oh yeah, I lost it. I misplaced here. Then you shoot yourself in the foot, right? Because you're not being credible now. Because you say but you can't show.
Yeah.
So what you say, you have to show. Then it becomes solidified, right? So I think that's important. Okay. So the keep proper accounting records, right? That's one. So that it makes the due diligence process much easier. Second thing is that if
Mr.
you,
Neo,
yes, yeah, sorry,
sorry to interrupt, but we
yeah,
have
sure,
a few questions that asked by the audience.
okay,
Um, there's this one question from William Ortinho.
yeah,
Sorry if I mispronounce your name,
mm,
but
yeah.
his question is: it seems like global crisis recessions is looming. In the event that there is a recession, to what extent will such crisis affect the decision to invest in startups?
Okay, fine.
Mm.
Let me answer this question, right?
True.
Yeah, the global recession is coming in. Yes, I think for me as a person who looks at financial markets, I would say that 12 to 18 months from now, you will see that when you see a recession, right? Technical recession is a 2 quarters of negative growth. Okay, and the US right now is now growing about 1.5%. So I think that they might hit close to zero or negative in the next quarter. And once you hit two negative quarters, you are considered a recession, right? Correct. So I think that's likely to happen because um, quantitative tightening as opposed to the quantitative easing, right? Quantitative easing, you print a lot of paper money and then money becomes cheap.
Mm.
But now that things, inflation is getting very expensive, and it's quite remarkable that whatever that US
Mm.
has done as kind of a macroeconomic policy, and you and me and everyone here on this call is feeling the effects of it, right?
True.
As you can see, like
True.
all your stuff is getting more expensive, inflation and the likes, right?
Mm.
So so now quantitative tightening means that they're going to withdraw the liquidity from the market. So the question to say that if the global recession is looming, then will it affect people's decision to invest? Now, I think to me that is actually um, it's not an absolute yes or a no. I cannot answer that question, but I can at least elaborate more on this kind of question. Right? It's more, um, I would say that you look at it from inference, right? Now,
Mm.
in a recession, why the recession comes in because inflation coming in, or there's a slowdown in consumption and everything.
Mm.
So sometimes it tempers people's sentiments as well. Okay, so
Mm.
people tend to be more cautious. Now, when you see that, right, obviously, some people will say that yeah, so the startups will have to because liquidity is being tight, and in recessions coming because of the slowdown. When the slowdown means some of those companies who have over leveraged, including startups, will fail.
Mhm.
And then when they
Mhm.
fail, right, all those VCs getting their scratches on their arms and everything will then feel a bit shy, right? Correct? To take new risk. Okay, so that's if you say that the recession causes this particular effect, then yes, I think the startups will find it very difficult to raise funds, right? But startups, right? As you call startups and venture capital, right? The kind of we call it the alpha or the beta correlation to financial markets is less than even 25%. Meaning you say that if the market is
Mm.
down, doesn't mean the venture capital company investment startups are down. Okay, and sometimes people will. In fact, you could work the opposite way around because the people in typical portfolio managers, they'll say, well, okay, fine,
Mm.
I'll do my portfolio allocation. Since the equity market is always heading south and there's a bear market, I'll take my funds out from the financial markets, being in bonds, be it in shares, and let me allocate some to the other alphas, right? The other alphas is yeah, startups or even up and coming mid-tier companies, especially for the private
Mm.
equity companies. Okay, venture capitalists will invest small amounts, smaller amounts than private equity. Private equity, I think usually typical and the bite size people go between anything above 20 million. Okay, right? So they are much the bigger investment houses, and they usually invest
Mm.
in the midstream, not greenfield project. Greenfield meaning like startups. Okay, so they don't do that. So to answer the question from William is yeah, if given the circumstance that you have all these things that cascading effects down that drains the liquidity, then obviously startups will be starved for cash. But if you say that there's uh, just that the financial markets is being hit and then money is being reallocated, then suddenly it works out to be the benefit of the startups, right? Okay. And right now you can see we call it the fangs, right, which is your Facebook. Actually, no, not fangs, it's called the mangs, right, because Facebook has been called Meta now, then the Amazon, and then the Netflix, and then the Google. So the
Yep.
mangs, right, not the fangs actually. So they obviously you can see that Nasdaq is being hit. And I guess you must have heard it from somebody, but that's our own personal view as well. I think there's going to be a jolt crash, right? Because just people are just markets coming out, everybody just keep trying to buy, but there's no logic to it, right? Because the price earnings multiples are so high that only I think the brick and mortar companies make sense, because the tech has ran so far ahead of itself that it has to have some sort of pullback, right? Like I guess I'm sure you read recently about Netflix now achieving a kind of a million, more subscribers. No, I mean they didn't. No, it's not that they achieved a lot. They didn't drop so much, right? And Apple is trying to trim down their spending. That was like 3 days ago's news. Okay, so you
Mm.
can see that that's happening, and then someone is saying that Tesla is not going to meet the production. The AI director has resigned, and then Twitter has been pulled off. So you can see all these things are coming to head, right? So, but I say that if the overall allocation of capital comes in, and of course, sometimes Asia Pacific seems to be in a better position, like what people say, is that the demographics in our region kind of support growth. And so when you support growth, right, it means that there's a lot of potential for startups, new ideas, to bring into new markets, right? So, and sometimes the likes are very simple. Is there some ideas in the West that's worked, and then it became scalable, and then ideas get transplanted into Asia, right? One very clear example was Uber started in the West, and then who came in? Grab, right? Gojek. So this is a direct translation of ideas across, right? And then you can see that IG was doing very well under Meta and Facebook, and then suddenly over here we have TikTok, right? So it's a clear translation of ideas here. But some new ideas, yeah, I'm sure they're bound to be, especially in the realms of um, the industries that we have in Asia. That is notably, like you see, agriculture, the likes of IoT, and I think the digitalization process is pretty much still early. I think, right, in terms of trying to digitalize process, right? I think digitalization is something that even in Singapore we see a lot of, and I'm sure likewise Malaysia and Singapore were quite similar in that sense. So we'll see a lot of the kind of process that people wanting to do, right?
So Leo, on
So
this same page, right, do you
mhm.
actually see that, the geographical location or certain country, do they actually attracts more, I mean, what I meant is like startups in certain country, do they attract more venture capitalist interest, or, it is equally the same across countries?
Uh, I think some countries in especially in Asia will attract more and some will attract less lah. I mean the one is sometimes you can look at the political climate. Two is for venture VCs coming in, right? The rule of law is very important. So if the rule of law is not really so much well established, then VCs tend to avoid that unless there's something very very compelling, right?
I
So,
see.
but I think likes of ASEAN is pretty much well established. So, I don't foresee any kind of difficulties. But you talk about competitive edge, right? I think the
Mm,
likes of Malaysia, like Vietnam, will have the competitive edge, and Thailand, because you have the critical mass, right? You got 25 billion.
mm,
Vietnam is about 99. Thailand is about 65. So Singapore is
mm,
just like 5.5.
I see.
So when you talk about market size, right? Malaysia has a huge potential, right? And because Malaysia, you spend across West and East Malaysia. If you don't look at East Malaysia, you look at West Malaysia alone, right? I mean, imagine the traveling distance from JB, right at the southern tip, all the way to I think the highest is maybe Alostar, or even further up,
Mm,
right? Uh, we're talking about what, 8 hours of driving, correct? So
Give
it's
or
it's
take,
a it's
yeah.
a yeah, yeah. So it's a huge country with a lot of potential for digitalization, right? Because people would want the kind of convenience of service and the accessibility to service and products, correct? So
yes,
definitely a huge potential. Yeah. So
interesting.
and likewise, you see, and the other thing is obviously the talent pool, which I think APU is doing well, a great job,
Mm,
because to create the talent pool for startups, right? Because young people in the universities, great ideas, lots of energy. But I guess the key point is you don't want to dampen people's energy, but they need to understand that with funding comes commitment and stewardship, right? So this is something that people need to understand, right? Doesn't mean you take the money is party time or happy go lucky. No, it's not going to happen, right? But I think this is a very good way to mature and to mature, not as in in terms of like personal development as well, but to mature in the business realm, understanding that running a company has its responsibilities and its commitment.
Actually,
Okay,
Mr.
so I
Leo.
think I've gone past the question of for William. Actually, I think I've covered a lot of those issues.
Yep.
I don't think I can
Coming to
answer a yes or no, but I guess I got to give you the whole scenario, and then you have to figure this out and see how to maneuver in this kind of environment. Okay.
Yep. Coming to the next question, sir, by actually Enterprise APU Club. We have a question from them. Among the three C's, which C is more important than the others? Or what should the weightage be like?
Hmm. Okay. So that question, right? To answer the question, right? The if I from a VC standpoint, I look at those three C's, right? Different
Mm,
companies will have different weightage of C's to me.
mm,
Okay. If that company is, let's say, for example, production, and they got all the
mm,
process ready and all the things running inside there, then the capability and deliverable risk is very important. And if the key man risk, if there's I guess if it's so production based, right, then the collaboration aspect doesn't be have such a strong emphasis for me because it's all processes and manufacturing, right? And then the character portion is important, equally important. But I guess if there's a breadth of players who actually contributed to the processes and the product itself, then if the key man risk is being um, minimized, then the character portion is again, not the topmost of priority, right? But it is always but you always start with the bold C first, right? Then after that you look down. Okay. Now when it comes to software companies where the founder knows how to write the software code and everything, wow, then that C of character becomes very big, right? Again, I quote the example of Theranos, right? Where Elizabeth was the CEO, and then she said everything is good, but she's not the person doing it. So then end up it's really the character that people have missed out. And now the fact that it's gone into the news, you say that all these people were VCs and private equities, right? These are professional people, and they still make the mistake. So no, when it comes to investing, right, no one is an expert, right? And I don't I don't deny the fact I'm still learning, right? Every day you come across different cases and you have to take risk, right? If everything is all definitive, then you'll be 10 out of 10 for every investment for a VC, right? So when it comes to software, like say someone writes the code, yep, character is very important because I don't need to look at the capabilities, because if you're able to build whatever software code but you have no character, then that software code is very vulnerable, right? It could be
Yes.
Leo,
something
would
with
I be
time.
able to have one questions? What is your advice, for our students, uh, in terms of like, their own career pathway, like yourself, coming from your background from engineering, going into venturing into something that is completely different, from your first field, that you actually have joined. So any advice? We have students from engineering and also technologist background,
I mean, I would, I dare not give anybody any advice, okay? Because I think that the only person I'm still needing advice myself, okay? So, um, but I would say that still, as a person who still want to look at ideas and work with, because right now I do look at still look at SMEs and I look at the founders, and some of them are distressed companies, and you need to try to work with distressed companies to turn them around, right? Correct. I think that's very
yes.
important. So, uh, in a sense, for the students, right? If you wanna, if you have an idea, you wanna do something, and then like people always say, right? You have the advantage of age. That you make a mistake in the whole span of your, uh, you know, 30, 50 years of career is 1 out of 50, right? Correct.
Mm.
So so I think that you can afford to try out, right? And it's better. But the important thing is try out is to test your ideas and to make sure that you to see whether your ideas can work. That, but if you want to test the ideas just because you want to make a lot of money, right? Then you have lost your focus because you can make a lot of money without by not doing startups, right? But what
True.
people want to do is
True.
people want to when you have the idea and you realize the idea has value, money will come naturally. So you don't have to worry about that. Actually, you just focus on value and getting things right. And once when you walk that path, that you stick that narrow path of being focused on doing what is right, everything I feel would fall in place. But that's where when you want to veer left or veer right,
Mhm.
and this kind of detour, which seemingly shortcuts, will lead to destruction. And I've
All
seen
right.
that too many times before to understand, right?
That's a
So I think,
very valuable advice, though,
yeah.
to remind
So
us
I
as
think,
well.
yeah. So I think that if you really seriously have a good idea, yeah, test it out by all means, right?
Mhm.
And then build on those ideas. And sometimes a little small spark, right, can eventually create a bonfire. So I think this is something that one should not be afraid to take risk, and the same time is one should not be afraid to fail lah. That's normal,
Mhm.
right? Like for example, being having started off as a very complex trader in a complex derivative trader on Wall Street. Well, you structure a lot of complex trades. You use Markovian Monte Carlo simulation process to price the level of a product in terms of risk. Then you take the risk on your books. That means
Mhm.
that if you can lose money, which I've done. Okay, so if you lose
Mhm.
money, then just make sure that you learn from your mistakes, and try not
Mhm.
to repeat the same mistakes and try to make money the next time, right?
Mhm.
So in terms of trading, is you can do 10 trades, you can lose 9 trades, and you make one trade, and you make the big trade, and then you end up making the the profit. Uh, so I think this is why sometimes people just have to keep trying, and someday they get a lucky break. You call it a lucky break, but actually you're basically making a breakthrough, lah, right? So I think that perseverance is very important, and I think to me is that uh, diving into startups, actually doing it, you may not realize, but after some time you do it and you're successful, that's great. If you're still struggling and chugging along, then you can see that it actually builds your character. At the same time, it builds your skill set, which is the big C, the
Mhm.
capability. So if a startup doesn't work, at least you have the capability, then you can
True.
still from there focus on your career. Because once you have the capability, right, you can still focus on your big C career as opposed to capital, right? So I guess this is something that I always tell myself, right, is that if you don't make it today, then just keep trying, because then you know if you stop trying, that's where you're not going to make it,
Mhm.
right?
Sorry, Mr. Leo, to interrupt,
Yeah,
but we
yeah,
have one more question from
mm-hmm,
Aida Khalili. I'm so
yeah,
sorry if I got your name wrong, but
mm,
she is asking, or he is asking,
mm,
what are the key questions that VCs can ask before investigating a startup? I think she meant
mm.
investing, but yeah.
Mhm.
Yeah, investing
Yeah.
before they get a startup, is it? You saying?
Yep.
Mm, okay, so let me just explain that. If you want to look at what we do. Um, Number one, like I say, the three C's, right? Earlier on, I think maybe Ida missed the point. Is that when you look at a company, like you say that I think earlier on the question from Dr. Angeline there was asking about, are they ready? When you're ready, that means the VCs are ready. Okay, maybe I'll answer your question the other way then. Okay, once when you feel that you have revenue and you have the POC and you're waiting for POV, you can actually start some sound bites talking to people, and then before that, obviously, you must tidy up your kitchen. When I say kitchen, means like your books, your process, your governance. And if you have something that is worthwhile that you can patent, then if you have those rights documented and say why these are something that's proprietary, that you want to keep it secret, and subsequently go for patent, then you can do that. Uh, and then when you're ready for investing, you have to think what type of investors uh, you want to look for. A strategic one that can help you access the market, or someone who
Mhm.
just give the money and is an armchair investor and let you run, okay? Or someone who can actually bring you more technology to be able to that you can actually build on, and then be part of a company. Basically, that one is like very close to being acquired on day one. right? Which sometimes there's a good and bad points, right? Is that if you are acquired on day one, then you could you could live well, but you may not live superbly. I mean, here's
Mm,
again the story, right? Is that Yahoo approached Google, or Google approached Yahoo. Yahoo was
mm,
looking at them, and then Google and say, nah, we're not interested. So then Google went out. Then the next time round, subsequently Google did well. Yahoo approached Google, and Google said, nah, not interested. First time. So no, so then end of today, you can see today Google is a larger market cap than Yahoo, right? Right.
indeed, indeed.
So now these are questions that you ask, right, when you're ready for investing or not. Is yeah, you have a POC, you have a product. When it comes to product, you have product ready, you have process ready, or you have the platform, your software platform ready. But if you are actually um, providing a service, then make sure you have those revenues. At least I say 12 months, I think will be something that will be good. Then that means that you can talk to potential investors and say, hey, I got 12 months of revenue right now, and I think that if you give me X amount of money, I'm going to build this, I'm going to do this for marketing,
Mm,
and I can double my revenue, you know then I think that's great, right? Because if someone value at 4 times earning, imagine this: 4 times 1, 4, you
mm,
achieve 2 million, then suddenly from 4 becomes 8, right? You've increased the
true.
guy by $4 million, right? People go to jump,
Yep.
right?
Yep.
So I think that's how the the kind of trajectory can go, right? Okay.
All right. Thank you
So I
very
don't
much,
know whether I
Mr.
can
Liu.
answer those questions, yeah, for Ida.
Indeed,
Ida,
interesting.
I
Mm.
hope you got your question answered. Um, Well, before I would like to end, to all the audience, stay tuned and please subscribe to our YouTube channel. We have a CEO CTO talk series next week,
Mm.
so you guys can catch it there. And also, not to forget, we have a big event coming up from Enterprise Club. We have our startup weekend on the 5th, 6th, and 7th of August. If you want further information, you can follow us on our Instagram page at Enterprise Club APU. And without further ado, I would like to say thank you very much, Mr. Leo, for your time.
Oh,
I
you're
hope
welcome. Yep.
everybody here has watching this live, and everybody uh, has learned a lot from this. And thank you very much, Mr. Leo. You have opened our
Oh, you're
eyes a
welcome.
lot.
Yep.
And
Yep.
not to forget, everybody, there's attendance, so please take your attendance
We just
before
want to
you.
also say thank you very much, so stay tuned with us, for every first and the third Wednesday of the month for the Enterprise Wednesday series. And we are your hosts for today, Professor Dr. Angelina and Divish. We just want to say thank you very much. Has a good week ahead of you. Thanks a lot, Leo. Stay
No
safe.
problem. You're welcome.
Stay,
Yeah.
yeah, stay safe and see you the next round.
Thanks for having me. Yeah. Okay. Good. Okay.
Good night,
Yeah.
everybody.
Thank
Take
you.
Okay.
care.
Bye. Bye.
Bye, everybody. Thanks.
Bye.